So, Nenad and I'm looking forward to talk about this topic. Spreads, of course, not something we talk about necessarily often. It's part of the business. It's part of trading. But we're focusing on technicals, fundamental analysis, wave analysis, for instance, right? Uh, Spreads is just one of those things that is part of trading. It's just part of our life, right? But this time we want to show you the impact of what it has on our trading. How does it impact us, and how can we improve that? So let's first talk about two currency pairs, just to get an idea about the difference and what the difference could be. So, for instance, the euro dollar has often, typically, right? We're just talking about typical spreads here, a range of 1 pip. So that means that the selling price and the buying price, the difference between those is 1 pip. All right, because that is, of course, what the spread is. We are buying slightly worse price, selling at a slightly worse price, and that spread covers the cost of the transaction to access the financial markets. So 1 pip, of course, that's very small, right? It's a very small difference. Some other currency pairs typically have a larger spread. Odd New Zealand is more of an exotic currency pair, so you're going to see that be a lot higher. Whether that's 6, 7, perhaps even more, it doesn't really matter. The point is that there's a big difference between those, and it does have an impact. How? It impacts us because it's a cost for us as traders, right? The higher the spread is, the more we'll be paying. As an entry and exit, it just adds up, right, in our costs. Instead of having perhaps 40 pips profit with the euro dollar, it might be, well, it could be some 10 pips less with the odd New Zealand. It could be 30 instead. So those 10 pips is just on one trade. If we were to do that, in the whole month, of course that adds up. So what is the practical, influence or impact on our trading? Well, with the euro dollar, because the costs are low, the spread is low, there is no limit in a way in what system, or almost no limit in the system we develop. Granted, I mean, it is, I think, not a good idea to aim for 1 pip target, even on the euro dollar, because the reward to risk is not going to compensate enough, even if your win percentage is really, really high. Even if you win 90% of them, right? But you gain 1 pip. So you got 9 pips, right? But one time you lose 20. Well, you gained 9, you lost 20. So you get the point. But besides that, there is a lot of potential possibilities, a wide range of systems that are usable on the euro dollar, including scalping. Now, for the odd New Zealand, obviously one of the most practical things we can tell you is that it is not good for scalping, right? Because if we're aiming for 15, 20, 25 pips, and we're paying 7 pips to get in, well, that eats up too much costs, and that is not a good combination. So that's the first practical thing that we wanted to mention. But that's just looking at the real cost. What is the real cost of entering and exiting the market? That's the spread. But what is the relative cost? Well, that's basically taking the spread, as you can see at the bottom, and dividing that by the ATR, which is the average true range. It explains and shows the volatility of the market. How much movement do we actually have on that currency pair? When the market moves a lot, there's big ups and downs, huge momentum moves throughout the day or throughout the week or month. In that case, the cost of the spread is a bit less relevant because if, for instance, the ATR is 500 and we pay 5 for the spread, then okay, we do pay a bit more for the spread, but we can expect also a lot more movement. So there's the potential to catch a bigger piece of the price action. Whereas the spread could be less, it could be only 3 pips, let's say. But if the ATR is not 500, which is of course very high, just making an example here, but is 50, that's 10 times as less, but the spread is only half. So that's relatively, we're paying a lot more to get into that pair and exit for a lot less potential movement. So what we looked at is some typical spreads and some ATRs. These are ATRs at the time that we looked at this and prepared this last week. These ATRs are not fixed. Of course, ATRs go up and go down because the market increases and decreases its speed and movement. So this is just one point in time, a measurement at that particular moment. So this is not something that always is like this, right? Just want to emphasize that. But at that time, gold, XAU, USD, when you look at the typical spread and you look at the ATR and you calculate that and you divide it, it was 1.23%. That's good, right? That's all. It's a small part, and that's fine. Let's take a look at pound New Zealand. Pound New Zealand, of course, typically more expensive to get in and out, but it does have a bigger ATR. So what was its percentage? It was 3.11, and that's already a bit higher. So from that perspective, I think it would be probably safer to say that it's good for a swing trade, right? But 3% is already on the high side. So it might not be good to scalp this one. Let's take a look at some others just to give you an idea. All right, the euro dollar, for instance. It had a low ATR. The spread was the lowest, typically, but the ATR was lower too. So the relative cost of the spread was actually the highest of these three. Do you see that? 1.14%. The others were both, the pound dollar and the dollar yen, were below the 1%. Now, this is not something that I would recommend to do and check every 5 minutes. Is it good to once in a while keep an eye on this, beginning of the week, for instance? Yes, I think it's a good to keep an eye on this, to monitor this, to see how we can reduce the cost basically where possible. So from this point of view, euro dollar, pretty good number, but the pound and the dollar yen even better. But of course, if we compare those to the pound New Zealand, once again, you can see that this is more expensive. Even though the ATR was 209 pips, the thing is that the dollar yen and the pound had slightly lower ATRs, 163, 151, but their spread, of course, was just a lot lower. So they had these very low numbers, 0.72 dollar yen, taking the gold medal there, having the lowest relative cost to enter and exit. So this is an interesting approach. I like it. It's clear cut. You just divide the spread, take that, divide it by the ATR. You can do it on the calculator, or you can just do it, just get a rough feeling for it, and you'll see that 1 divided by roughly 100 is 1%, right? If you round 87 up to 100, it's roughly 1%, right? If you divide 1 by 150, you know that it's less than 1%. So you can do that if you want to do it quickly. So another way to have an idea basically about the volatility and what kind of range is not only the ATR, but is also on Admiral Markets website, is actually a very cool market heat map. This is part of it. Market heat map is more than this. It also looks at the stocks and the commodities. There's this green and red panels that show the hot movers, the big movers. This is a different one. This shows the directional movement up or down and volatility. The more the currency is to the right, the more volatile. The more to the left, the more it actually didn't move. Very useful. I take a look at this regularly in the live webinars I have on Tuesday, Wednesday. So that's very, very beneficial to get a feeling of which pairs could be interesting, which pairs could be best to avoid. Now, the good thing is, good news for everyone here, so this is important, is that Admiral Markets has a special for February. You can find it on the website. Just go to admiralmarkets.com. You'll find it right there at the top. And it's basically for 5 particular financial instruments: euro dollar, pound dollar, dollar yen, AUD USD, and gold. You will have basically the opportunity to get a 20% discount on those spreads, 20% reduction in costs throughout February. This is a special offer from Admiral Markets to us traders, so it was a good moment to talk about it during this spread webinar and let you know about this 5-star spread offer. And yeah, 20%, well, I think it's a great deal. Let's face it, if you walk into, let's say if you go for a coffee and they say, well, it's a 20% discount, I think everybody's happy. So same is valid for these spreads. So this is a live, if you go right now and take a look, this is a live, up-to-date kind of table that changes per second sometimes. So this is not a fixed, level. Euro dollar could be now 1.0. This was just at the time for a moment at 1.3. Right now it could be 1.0. The pound could be 1.3. The dollar yen could be 1.5. You get the point. But the point is also to add that, as you can see, there's a 20% reduction. So you get these spreads on the right side rather than the left side. You can have an idea about how much you can save with that. What is your potential saving? What kind of costs do you actually avoid with this 20% special offer? And then take a look at the requirements. And then if you want, you can take a look at the open a live account. Here's the link, by the way, just in case you want to go directly, or you can go once again to admiralmarkets.com, but then click on the main page to this particular offer. So that's exciting. Who's looking forward to this deal in here in this live webinar? Raise your hand. Wait, that's not possible. Write a chat, yes, if you're looking forward to those 20%. Admiral Markets is always thinking of new ways how to help traders. Last September we had the Zero to Hero project, of course, with a 21 video course ranging, from the very beginning to a bit more advanced material with a system that's still available, by the way, on the website as well. Here you can, let me show you quickly. This is the heat map, by the way. You can go to education and then Zero to Hero. That's still available. All right, so let's talk a bit about that volatility. Volatility can be quite demanding as price makes ups and downs throughout the day. Let's just think about the euro dollar today: up, down, sideways, down. It makes a lot of these moves. Not every day is a trending day. Not every day moves as nicely as the pound yen does to the upside or the euro yen did today. Sometimes price just goes flat. And the pound odd, for instance, was a good example of such a flat move today. In any case, volatility can sometimes be difficult to grasp. So there is an extra way Admiral Markets offers too. It's the volatility protection settings. So you can find it on the website too. Just wanted to mention that that's available. I won't dive into that now because we've had a webinar already on this particular topic, but just a recap and refresher that is there. More on stop losses. I wanted to speak a bit more on that, is the fact that, of course, stop loss placement is something that is of uttermost importance. Without a stop loss, we cannot define our risk. Well, in fact, the risk is everything, right? Because the whole trading capital and more perhaps. So that's why having a stop loss is important, because then we can say, okay, I'm risking till here, 1%, 0.5%, 2%. I'm willing to lose that. I'm taking a calculated risk, and I'm okay with that. And I'm following my trading plan, and I'm following my trade management plan. And if I lose, that's part of that system. For the long term, I'm expecting profit because I've done testing and I've done trading before, so I can see, or not, maybe you're using a new system, right? That's fine too. But you want to stick to those rules, and that's fine. But that's why we need a stop loss. But where do we place the stop loss? That is something of a crucial question. It's always a difficult topic for traders. I prefer to use the invalidation level, a spot where basically if price goes through that, my analysis is not valid anymore. So from my perspective, when I'm, for instance, looking at waves and fibs, and I would be looking for a, let's give an example here, reversal somewhere in here, right? And I put the stop loss above it, it makes sense. It makes sense because that is my invalidation level. Of course, the market could go up and tag it out later on, and that depends on how I manage the trade as well. Maybe I see the price going my way, I see a cluster of candles, and I move it to above those candles, and I get break even. If I don't do that, then yes, the market would hit my stop loss. But those things happen. In some cases, one can consider that like a stop grabber move. Whatever it is, our stop loss gets hit, and it could be that this is a grab here of the, let's say, of the market that is moving into that area, because there could be a lot of closures, exits for failed shorts, and those things are possible. But from my perspective, I try to always use the spot that my analysis is invalidated, and therefore I don't have to worry that much about, in my mind at least, about where could be other stop losses and where would be a good moment to avoid these potential grabs. And a bigger chart, yeah, of course. Sorry about that. Somehow it just disappeared. There we go. Let's see. There. All right. So I like to use invalidation levels. For instance, if I put a fib from here to here because I'm expecting an ABC zigzag, let's say, just a hypothetical example, and I'm looking for a 50 fib bounce, one of those invalidation levels could be the bottom here. But it doesn't have to be. If I think that price will not break below the 61.8, I sometimes go below the 61.8. So I put it down in here, and I take the 50 bounce. You don't see the fib. Apologies for that, and I put it below, just a bit below, and that's also fine. If it continues and hits my stop loss, then that is also a potential invalidation level. All right, so that's where I like to use and put the stop loss. That's my main message. The invalidation level, when I go with that, I feel comfortable, I feel calm with my stop loss at the spot that I know, okay, my analysis is out of the window anyhow. I kind of deserve that loss, if you know what I mean. I know that sounds maybe a bit funny, like we of course always want to avoid losses, but then I feel like at peace with it in a way, because that was my analysis, and it didn't happen. Whereas if, for instance, I take this trade, but I put the stop loss 10 pips below that, and I get stopped out, and then I see the market go my way, then my analysis was not invalidated. My analysis was actually correct. The invalidation level was lower. I was just trying to, in a way, cheat a bit, or not cheat maybe is the right word, but try to get a great reward to risk, and that didn't work out, and the analysis actually proved itself right, but I lost another trade. So this is what I tried to avoid. That feeling like, oof, you see, I was right, but I still lost. Let's see some questions, I think, or some comments. I honestly, well, from my perspective regarding the movements in the market, I see it as the psychology of the market. So I personally look at it from a wave perspective, from a market structure perspective. So I don't necessarily see it as the market grabbing stops, but I know that a lot of traders do look at that way, and that's fine. I therefore also wanted to show, talk about it like that, because I know that many do look at it from this perspective. For me, I just see an ABC zigzag. I see an ABC zigzag. So that's my bias. That's my perspective. Let's see. Gabriel saying, sometimes I go to a trade with stop loss, and always the market goes and takes my stop and carry on in my predicted move. And when I don't have a stop loss, the market never went against me. It is a bit of a Murphy's Law, I think, unfortunately. And yeah, that is indeed, I can imagine, shaking some of our confidence in trading and how to approach it. And I think it could be a good topic on as a separate webinar. We talked about stop losses, but I think it was quite a while ago. So I think this is a good topic for a future webinar indeed. But maybe this tip, looking at the validation, using maybe not the nearest support or resistance, but go two support or resistances away, not using the nearest fractal maybe, right, but one further. Let me see if I can find a quick example. So if I short it here, maybe not putting the stop loss right here, although it would have worked in this case, but putting it here, right, just giving a bit more space. So maybe these two things could help, invalidation level and giving it a bit more, just a tad more space. So with that said, we're going to be talking now a bit about how you can capitalize on these lower spreads, right? And those are quick systems, intraday systems, maybe even scalping. So now that I want to talk a bit about that, right? How can you capitalize on this discount that is available? And well, one of the ways, of course, you can by trading, you can capitalize on that, but maybe a bit more if it's intraday or scalping. Now, of course, be aware that you should feel comfortable with trading. So whatever you choose to trade in this month, make sure that you feel comfortable with that. And just because there is a discount doesn't mean you have to go without any borders, right? Just because the coffee is 20% cheaper doesn't mean we have to order 50 cappuccinos in one day necessarily. So find that balance, right? Strike that balance what you feel comfortable with. But sure, it is a good moment to trade this month. That is true too. So let's talk a bit about this. Let me get the charts here, and then it will continue after this. And it will show you some systems, I believe, or some indicators. And well, from my perspective, folks, I'm not a big scalper, so I'm going to just throw it out there. I like 1 hour, I like 4 hour charts. But more and more I am looking at 50-minute charts too. I think it's Fascinating as well to look at the movements throughout the day and try to catch those trending trades that happen sometimes, like the euro yen and pound yen to the upside today. When I look at the market, I like to use bands myself, an oscillator, and a moving average, like this example, for instance. Let me get rid of the fib. I don't know why it's there. Sorry. Now, the reason why is that this is not a system. I just want to share you the tools I like. Nenad is going to be talking a bit more about a system and indicators as far as I remember correctly. The tools I like, why do I like this? Because I think for short-term trading, it's very important to find moments where we go, for instance, for reversal trades, we get out of a oversold zone or out of an overbuy zone. We have divergence, for instance, stuff like that. Here, for instance, we top out and we go below the 100 level. This could be then a double top and a reversal. It's at the Keltner. So using a Keltner and a CCI, for instance, as a combination is a powerful mix because the Keltner, the Admiral Keltner indicator, part of the MetaTrader 4 Supreme Edition, is showing where there's the physical support or resistance on the chart. And then the CCI kind of goes along with that, indicating if there's an oversold or overbought situation. And I use this particular moving average for basically the momentum, right? You can see neatly indicating the momentum there, and that will indicate whether the momentum is switched, and that's good for trade management. Is it still going my way, or is it going into consolidation? So these are tools I like to use, fractals too, when looking at intraday charts, and I think that gives me a perspective of where is oversold and where we can bump into, where is there confluence, etc. This moving average is not a typical moving average. It is right here, as you can see. This is the name. So you can write that down. And yeah, it's good because it shows momentum. It shows where basically there's a strong push. It's a combination of price and time factor, what I like a lot about it. So you can see that this is a strong momentum, and this MA really shows and captures that very nicely. And it also captures where there's a good chance there could be the end of that, here and here. All right. So that's just my 2 cents. But as I said, I'm more of an intra-week trader myself. But now it's time to say hi to Nenad. Welcome, Nenad. And let's see what good info we can get from our dear Nenad.
Hi, Chris. Lovely introduction to lower spreads. Yeah, now I will actually show you what I have with our lower spread campaign and why you should use it. So definitely, guys, the main benefit of trading lower spreads is that you will pay less. As Chris has explained already, the thing is that well, if you know that you can have a discount on something, why not use it? I mean, everyone loves discounts. You know, whenever you go to shop, whenever you go shopping something, whenever you try to buy something, you always expect some sort of discount, right? So discounts are always good, and I personally like to use these kind of campaigns and open some, let's say, new accounts and using lower spreads, especially if the account that is in question is not ECN, because usually ECN accounts are with low spreads, and when you can have low spreads on the account that is different than ECN, that is also very, very, very good thing. So today's agenda on my part will be main benefits stop grabber pattern. I will explain why stop grabbers can be more dangerous when you have higher spreads. Then correlation, and definitely I will show you how good it is to actually scalp with my 5-minute MACD system. So the first thing is to define what is a tight spread. What is actually a tight spread? What does it mean? Well, let's say that the tight spread it occurs when there is only a small difference between the price at which you can buy a market and the price at which you can sell that market. So I'm not specifically talking about Forex markets. So you can have lower spreads, of course, on other instruments such as DAX, such as gold, so equities, metals, but we are specifically talking now about Forex market. But generally, spreads can be lower on various spreads. Now, we are primarily focused on pairs that are heavily traded in the market. So whenever you actually open a trade, your brokers will charge you for each trade. So that charge is usually in a form of commission or in a form of spread. On ECN account, because on ECN account spreads are very, very low, you will pay for commission. But on standard Admiral Markets account, where you can open, you can easily open it, it says popular on the picture, and you will have lower spreads. That is a very, very good thing because the spreads in questions are accounted for pairs that are heavily traded in the market, and that is a great thing. So here I will show you now how it looks. Okay, let me just move my screen and you will see it here. So here, you see, so there is Admiral Markets account and Admiral Prime account. So here you will see that actually by opening this kind of account you will have low spreads, and this is sort of ECN account, this is ECN, so it also requires a larger deposit. So grab the opportunity, guys, leverage 1 to 500, excellent. I already explained why this leverage is used, so you can use lower leverage such as 1 to 10, right? But you can also have a benefit of higher leverage. That is a very, very good thing. So also a lot of people are not sure what is a spread. Chris has already explained what is a spread, but definitely, guys, once more, for all of you who are listening, who are new to this, the spread is simply the difference between the bid price and the ask price, okay? The bid price is the price to buy a pair, and the ask price is the price to sell a pair, okay? So bid, ask, buy, sell, okay? Very, very easy. When the spread is tight, it means that prices do not need to move far in your forecasted direction before you are in black and starting to make gains, okay? So it means that you should be able to make profits faster, okay? Also, it is a difference when total losses and profits are tolerated, okay? Experience some of the tighter spreads in Admiral Markets account, and you will see that what I'm saying will be highly beneficial to you. It means also that it will be a cheaper trading around news, because guys, usually around news, that small spread, that difference can make a huge difference between win and loss. As Chris already explained, how many times we were right about direction, but because of some spikes that are contributed also to spreads, we lost the trade. So that is why you always need to add the spread to a stop loss. So whenever, guys, you make a stop loss, add the spread to a stop loss, okay? So it's very, very, very important that you understand that it's also connected to stop loss. Many traders, and unfortunately, guys, some of experienced traders too, they simply they don't add the spread to a stop loss. I mean, there is, okay, it's okay logic if you use always like fixed stop loss of, let's say, 100 pips, and your risk is low. But it does not have any logic if you use 100 pips of a stop loss and your risk is 30% on a trade. I mean, there is no point in that, right? So you definitely need to understand that lower spread is a very beneficial thing to a trader. Back in time when I started to trade, around 2008, well, the big problem was finding a broker that had low spreads. And I remember I was really searching for brokers because some of the brokers were actually prohibiting scalping. So you couldn't scalp. I mean, I remember the rule was that you should have had like 15 minutes trade open, and only then you could close your account. So many brokers back then prohibited scalping. So I mean, why it was a bad practice back then, but fortunately things have moved in a positive direction, and you can really benefit from opening a lot of position during the day. I mean, not of course in the form of high frequency trading literally, but you can manually open a lot of positions, manage those positions, and and really reap the benefits of low spread trading. Also, guys, with the account that I showed you, you don't have to pay any commission for those pairs listed. So usually there is no commission paid for those kind of pairs. It's very important for ATR to, as I already explained, you need to watch the spread. Okay, ATR is very, very popular indicator. I have already shared the ATR indicator that I use, and you really can see the power of ATR. For me, in intraday trading, it's a very useful indicator, especially because it plots levels, projected levels, so we can easily see when pairs overshot the average ATR and where we can actually take those counter trend trading opportunities. Okay, so it's a big difference when we speak about low ATR with high spread and high ATR with low spread. So let's say that Australian dollar New Zealand, that is also a popular pair, but it moves only, let's say, 60 pips per day, because it's usually a pair that doesn't move a lot, except when there are some use. But average true range for, let's say, 14 days is very low. So you will pay, let's say, for Australian dollar New Zealand 5 to 6 pip of a spread. Now for euro dollar, it's moving like 90 to 120 pips a day, and you will only pay 1 pip spread. I mean, it's definitely a no-brainer which of those pairs you should be trading, because I mean it's pretty much very, very logical. So you should reap the benefits of heavily traded pairs, the pairs that many people trade. Why is that beneficial to you? Because guys, when you do technical analysis and when majority of traders see the same thing as you're seeing in our moment, that means that your trade should go in a positive territory. You know, when a lot of traders, when majority of traders trade euro dollar, gold, dollar Swissie, pound dollar, it means that the market will respect the will of majority. And when you trade some exotic pairs, well, I must say that spikes and whipsaws will be much higher, and that is of course due to the overall liquidity of those pairs and of those actually of those markets traded. Okay, so very, very, very important to understand the concept of trading lower pairs. Pairs that also have low ATR are covered with low spreads that are offered now with Admiral, and those are euro dollar, pound dollar, dollar yen, dollar CAD, and gold. You will have 20% of spread reduction on these pairs. Okay, Also, there are standard account types, okay? You need to differentiate between standard account type, ECN type, and various benefits. ECN account usually have very, very low spreads. And also, you also need to understand that spreads can influence bid offer with your limit orders. So if you make limit orders like buy stop, sell stop, buy limit, sell limit, you need to include the spread again, guys. I mean, I know it's you maybe probably majority of you don't have the knack for taking the spreads into account, but you should always think about it. So not just for stop losses, but also for those market orders. Also, you need to know that if you trade ECN, you're only limited to Forex pairs, including gold that goes with other name. It's XAG dollar, and you don't have that kind of problem with other account, because the other account that I showed you, standard account, will actually give you the benefits of additional trading possibilities with equities, with metals, with stocks. Okay, so it's different. So gold on ECN is actually XAU USD. Okay, XAG is silver. It has ECN has gold in it, but it doesn't have anything except gold, silver, and Forex pairs. While the other account, of course, it has, as I said, equities and a lot of different stuff that you can additionally trade with Forex market. So it's very, very good to know that if you actually open the account to the left, this one, you will have low spreads on those pairs that I've showed you, but also you will be able to trade equities, also metals, stocks, bonds, and enjoy, of course, this leverage. I mean, really, this kind of leverage can help you to get out of a problem if your account is in a drawdown. Okay, so reap the benefits. What is a stop grabber? Chris already explained what a stop grabber is, but I need to differentiate because some people think that stop grabbers are something that brokers, market makers do. No, guys. Brokers do not make stop grabbers. Market makers do not make stop grabbers. Stop grabbers is simply the name for a pattern that appears when a huge order is placed and it collects all stops above. Those are called weaker stops. So institutional traders and retail traders usually call these kind of stops weaker stops. So what does it mean in this example? Let's say, guys, that we want to trade this to the short side. So we opened a trade here and we placed our stop loss here. Okay, you know, well, simply said, the majority of traders also put their stop losses around this region. Some traders put it there, some traders put it there, some traders put it there, and even some traders put it there. Because it was the logic, right? It is a technical analysis. So if a large order has been triggered here, okay, the order will collect all stops here and the price will go up, collecting all stops. Why? Because every time when you see a close of a sell order, of a buy order, your platform will do vice versa. So here we can see that sell orders have been closed here, okay, and that means automatic buy into the market. That is what platform does in background. Whenever you close a sell, it is automatic buy into the market. And now imagine that majority of traders positions were closed, so all of their positions were closed, or sell positions, So it is automatic buy into the market, and price makes the stop grabber. But this stop grabber is always seen after the fact. Because how you can describe a stop grabber? You see, this is not a trend change. What happened is the price went down, and again it went originally in your direction. So that is what Chris explained. So we were right here for our direction, but we had a stop grabber pattern, okay, and that hit our stop loss, but then the trade proceeded in the original direction. So it's just the name of the pattern. It's triggered by large orders, and it happens when stops are triggered. When you have lower spreads, okay, you have the margin. So guys, if you have 6 pip spread or 10 pip spread for the pair, you need to add 10 pips to your stop loss. It's much. I mean, for me, and I really hope that you agree with me, it's too much. So that is why lower spreads, when you make a trade with a pair that has a lower spread, it will be beneficial to your stop loss and to your limit orders. Okay? Also correlation, guys. You need to take account the correlation. Okay? Correlation is, as you know, numerical measure of the relationship between two variables. The range of correlation coefficient is between, let's say, -1 and +1. But on Admiral Markets, we have even diversified correlation table. So we have like +1 to +100, -1 to -100. The bigger the number is, the higher the correlation. So we already talked about correlation. You can visit our webinar about correlations. But why is it important for lower spread? So let's say that euro-dollar typical spread is 1, and let's say for pound-dollar typical spread 1 to 4. Now, it means that when you use all these spreads, okay, you need to see if you are double exposed to the currency. So let's say you trade euro-dollar and pound-dollar, and there, let's say that there is no correlation. Okay, let's say that there is no correlation. It's okay. But if you have a high correlation, let's say, between euro-dollar and pound-dollar, it means that you will be double exposed to dollar currency. Now imagine that these pairs have higher spreads. You will be paying more for basically the same thing, right? You will be paying more for dollar trades. You will be double exposed to dollar movements. Why would you do that? There is no point in doing that, okay? Also, guys, euro-dollar has a bit higher ATR. So let's see. Let's check it. What is now? Now euro-dollar started to move, so we can actually check how it goes. So yes, I will use this chart. So you see, euro-dollar, now it's 83. It was even below 80. Now it started to move. Pound-dollar, now it's 129. So I think it's a pretty much good range for a pair. Dollar-yen, 135. It's very good. Dollar-CAD, 103. And of course gold, it always moves a lot, right? So, well, what I'm trying to say is that all these pairs have a high ATR, and if you use correlation matrix, you will easily see, okay, you can see it here, you can easily see which pairs are correlated and which pairs are not correlated. I mean, you just need to enter the symbol, okay, let's say we have a host of tools here, so we can use whatever, most of those are here. Let's say a euro, Japanese yen, for example, add, and you can compare it there. So let's say, for example, for correlation table that, let's say, do we have euro GBP? I will use, okay, euro GBP and pound dollar, let's see, pound dollar. You see, guys, minus 95 correlation. It means those pairs are negatively correlated. So they move in completely opposite direction. If you compare the current ATR of, let's say, Euro GBP, that is definitely, I think, less than pound dollar, but let's see. Pound dollar ATR is, let's see, pound dollar is 129, while Euro GBP is, let's see, Euro GBP is only 79. You see? So when you compare the current ATR of Euro GBP to ATR of pound dollar, it's very easy to see which pair to trade. Moreover, the spread on Euro GBP is higher than the spread of pound dollar. So you can go here, open mini terminal, okay, and see that the spread on Euro GBP is higher, okay, than the spread on GBP, okay? So again, GBP simply moves with a higher ATR. And by trading, even by trading these two pairs, you can have a pair that is discounted, okay, with very low spread, and a pair that has no direct influence on double exposure. Okay, GBP, even if you're wrong with GBP trade, you still can be good with Euro GBP because ATR is low. You know, you won't be stopped. You don't need to use big stop loss. That is very important to understand. Okay, now on a live chart, I also want to show you how you can use the benefits of trading these low spreads. For me, I personally also, you can see I have live, this is another live account I have with Admiral here, and this is the account that I was showing you, that standard account that has everything here. And you can easily see, I mean, definitely I would go with Euro dollar, pound dollar, especially because Euro dollar is very suitable to trade with the system that I showed you, that I created. It's a 5-minute MACD scalping system, and you can try that system. I already explained this system, and you can find it on YouTube. The main benefit of this system is that it's also created for Euro dollar and pound dollar trades, so you can try to trade these lower spread pairs like Euro dollar, pound dollar, dollar yen, and dollar CAD with it, but focus is on Euro dollar and pound dollar. And open your mini terminal, and you will see what I'm talking about here. Okay, very, very, very low spread. ATR here means that this is the average true range of 14 days. This is projection for today. The projection is the high of 0.736, the low 0.627. These are projection lines. So it means when this pair gets here, it will hit projection low. If it gets here, it means it will hit projection high. If this is overshot, then this yellow line will appear below and or above this. It means when you see that these lines appear above or below this dotted line, it means that the pair has been overshot. Okay, so the chance of reversal is higher. So that is okay. So with this system, first of all, you will have only spread to pay, the cost of your trade. You don't pay for any commission. And guys, it's pretty much logical that you would rather trade Euro dollar and pound dollar than, let's say, GBP Swissy that has 5 to 6 pip spread. So enjoy the benefits of this, and in addition, you will be also able to trade metals and, of course, different equities. So if you are interested in the system but you don't have a template, feel free to email me. It's called 5-minute MACD system. It's solely done on 5 minutes. Just feel free to email me and I will send you the template. The information about everything, Mario is asking me only Euro or GBP deposit. Here you will find all the information about deposits. I personally have my account in Euro. Okay, so I hold my account in Euro, so you can see everything here. This is the account that you can open and enjoy the benefits. Okay, and you will see no requotes. That is also very important. and you will be able to actually use those spreads while it lasts. So thank you guys for listening. Any questions, feel free to ask. If you want this system, just send me your email request. I will send you the template. And I personally like the system. This is my creation. I like it a lot. And it's very, very good to scalp. Focus on euro dollar and on pound dollar. That is my advice. And of course, you can trade dollar yen and other pairs with this system, but the focus is on euro dollar and pound dollar. For all gold traders, you also need to know that gold also has lower deposits, so you can also try to trade gold and enjoy lower costs for the trade. Thank you guys for listening. As I say, anything you need, just send an email. And of course, new analysis expect soon. I will probably do dollar yen. Today we had a good analysis, just a slight digression from our subject. So today we had a good day for trading again. I like these days. I mean, very good day to trade. Yesterday we had master candle continuation, and today, if you read the analysis, it was dollar CAD, 2 bullish order blocks. Also, guys, have in mind that with this system you can try to trade dollar CAD. Okay, try to trade dollar CAD, but focus on euro dollar, pound dollar, and dollar yen. Thank you for listening. Talk to you soon, guys. Cheers and trade safe.